Hi guys, welcome to CA Inter Financial Management MCQs. I'm CA Anuj Jalota. We are on a mission to be doing every possible question that can be asked in exams of MCQs. Mind you, for costing, already every question is there on our YouTube channel. You all can go through all the MCQ videos that are there. And one more thing, on every Saturday, Sunday, for the benefit of everybody, our regular lectures of costing of previous batch are coming out. They cover every aspect of the module, okay, and they give you rankings of every question, summary of every question, and also a test at the end of every chapter, enough for you all to be getting 90 to 95 plus in costing subject. Make use of those videos, currently in English, Hindi. Once that is over, completely in English. Okay, let's start it off. The things for today. So therefore, our question for today revolves around working capital, okay, and there are many forms of working capital. There are a lot of things that get covered under working capital. Working capital is current asset minus current liability. Current liability is also called as short-term finance, okay, so there are few things against that. Let's start to be doing it. The question is, the bank financing of working capital will generally be in the following form: cash credits, overdraft, bill discounting, bill acceptance, line of credit, letter of credit, and bank guarantee. This statement is, give me the three options please. Correct, incorrect, C cannot be saying. In case you know the correct answer, we have discussed most of them in our practical chapter. So in case you all know the answer, comment at this time. Okay, now see, the answer is correct. Okay, I'll just try to explain few of these things. So therefore, like, the things get registered in your mind. Okay, might not be able to explain all, else the video becomes very big. But I'll try to be explaining most of these things. Most of these things come on the liability side. Okay, in your current liabilities. Let me explain you. Say we'll start away with cash credits. So cash credit is actually what? It's a short-term loan that the bank gives you, okay, as it is there on the screen at this time. A cash credit facility is type of short-term loan or credit extended to the business or individuals to address the urgent financial needs. Suddenly one supplier says that I want the money today, else I'll stop to supply. That is an emergency need. Where do you go for such kind of emergency need? So one of the things that you all can be doing, you all can avail cash credit facility from your banks, okay. As it is written, typically during the crisis or unforeseen circumstances. Suppose like, you were doing a business, something happened in your family, you are in urgent need of funds, you can be availing that. This facility is characterized by quick disbursement, minimal procedural requirements, and flexibility, making it ideal for situations requiring immediate liquidity. Now, following 5 points, I'll try to be saying. It's short-term in nature, first of all. Okay, so like, typically like the cash credit things can be revolving from 3 months to 1 year. Quick approval, you get approvals from the bank very fast. So today, if you apply, by tomorrow, you should be able to get it. Now, obviously, interest rate is very high because like, risk for a bank is higher and you had an urgent need. So bank will be taking advantage of that. Apart from that, collateral might be needed in most of the cases. You have to be keeping something as security. It could be your shares, it could be some property, some jewelry, etc. Use case means where cash credit is usually needed. It is usually needed where some urgent requirement of funds is there. And eligibility will depend upon your credit score, your relationship with the banks, and all those things. Okay, this is the first thing. So cash credit is a form of short-term loan. Then you have bank overdraft. Everybody knows this is a facility that the bank has given to withdraw more than whatever is there in your bank account. Okay, so whatever you withdraw, okay, interest will be only coming on that. And how do you repay that? I guess over a period of time, your inflows will be more than the outflows. So therefore, loan will automatically keep on getting repaid. So pre-approved limit, usually bank overdrafts will have a pre-approved limit, say of rupees 2 lakhs. So therefore, you can withdraw. Suppose you have, say, a positive bank balance of 50,000. Your bank OD limit is 2 lakh rupees. So you will be able to give a check to somebody of 2.5 lakh rupees. 50,000 you had plus 2 lakh rupees of bank overdraft. Interest charges are usually high, okay, because bank has to be earning money out of it. Flexible repayment, as I told, there's no repayment schedule. As in when your business will keep on happening, inflows will be more than the outflows, you can repay the things. Then collateral mostly will be needed, but it also depends upon your credit score, your past history, your relationship with the banks. Use case that is required, like, wherever some supplier has suddenly asked for the payment, okay, or suppose like, your inflows have been delayed, but still the outflows have to be there. So therefore, in that case, bank overdraft is required. Renewable, so therefore, like, you have to try to renew this thing, say after each and every year. After each and every year, the bank will tell you, like, your bank overdraft contract was there for a year, so therefore please renew that. There could be some charges of renewal, or if suppose your relationship with the banks are good, it might get waived off also. Further, bill discounting from 11th standard, you all know that we sold the goods to a debtor, okay, so we got bills, okay, these bills we try to sell to the banker, okay, and they give us something less, okay, whatever they all keep, those are the bill discounting charges, okay. So it's basically like factoring, to be honest, okay. Bill discounting is a financial service whereby the business sells its accounts receivables, that is bill of exchange or invoices, to a bank or a financial institution at a discount in exchange for an immediate cash. It's a common method to improve cash flows and manage working capital. Obviously, one advantage of that, you immediately get a cash flow, okay, your debtors get converted into cash flow, banks will be charging the discounting charges. It's a method of short-term financing, okay, you will be able to liquidate your debtors on an immediate basis, so therefore you immediately get the money. Further, there is no debt creation. Now, if you would have taken a loan, something would have come on the liability side. But here we are not affecting the liability side. We are converting debtors directly into the cash bank. Okay. Obviously, after reducing the discount. Now, do remember that the drawer of the bill of exchange will always remain liable. So, in case customer does not pay the money to the bank after that credit period, it will be the responsibility of the business to pay to the bank. Okay, so please keep this particular thing in mind. If you'll remember factoring, okay, then like this is something like with recourse. Okay, it is not something like without recourse. It is with recourse. So therefore, you bear the risk of the bad debts. Okay. Letter of credit, this is mainly used in case of exports and imports. I am the exporter. Okay. There is somebody in Australia who is the importer. He wants to be buying the goods from me, so therefore I'll be selling the goods to that particular person. He has to pay me. I will require a letter of credit from his bank. Letter of credit says that in case that importer will not pay, bank will be paying me the money. This is required because distance between us and the buyer is very high. So therefore, I cannot go to Australia to recover the money here. So therefore, this is the letter of credit that it is used. It is a commonly used in international trade to ensure secure and reliable transactions. So obviously, bank is guaranteeing you that in case importer does not pay, the bank will be responsible for paying. There are conditions that are mentioned, like, we are the seller, so therefore there are certain conditions that goods have to be shipped within this much time. It has to be reaching in this state, okay, in Australia. So therefore those conditions are mentioned in letter of credit, okay, all those conditions. You cannot alter these conditions, okay. So parties involved here will be us, will be the importer, and will be the bank over there. So therefore these are all the parties that are involved, and it is irrevocable. Irrevocable means once the bank will issue the letter of credit, it cannot be withdrawing that kind of a letter, okay. So therefore, because I have done the transaction based upon the letter of credit, so therefore the bank over there cannot be withdrawing those things, okay. So I guess answer is correct. That is what I told you all right in the beginning. That's it from my side for today. I'll see you next time in another question. Till then, take care guys. Bye.